Welcome. Let me start with a paradox that sits at the heart of modern investing. The more money governments print in the name of stability, the more fragile the system becomes for the individual trying to preserve purchasing power. We are told that expansionary policy is compassionate, that it smooths cycles and protects citizens. Yet, decade after decade, the very people it claims to help find themselves running faster just to stand still. That paradox is where today's conversation begins, and it's also where it ends. Because by the end, I want to leave you with a truth about freedom that most people sense intuitively but rarely confront honestly. I want to talk about a choice, not a trade, not a quarterly allocation tweak, but a civilizational choice that is quietly unfolding beneath headlines, beneath political theater, beneath daily market noise. The title of this conversation is simple: Bitcoin versus gold. And I want to be very clear from the start. I have already made that decision. What interests me is why so many intelligent, well intentioned people have not yet realized that they are being forced to make it too. For thousands of years, gold has been the ultimate object of trust. Not because a government declared it so, but because human beings, across cultures and continents, independently converged on the same conclusion. Gold was scarce. Gold was durable. Gold was difficult to counterfeit. Gold did not decay. In other words, gold embodied discipline. It forced restraint on those who held power because no one could simply conjure more of it at will. That constraint mattered. It anchored value to something beyond politics. But here is the first uncomfortable question we must ask. What happens when the world changes faster than the properties that once defined trust? What happens when the speed of information, the scale of global coordination, and the abstraction of value itself outgrow a physical object dug out of the ground? We live in a digital economy, whether we like it or not. Value moves at the speed of light. Capital crosses borders in milliseconds. Entire industries are born, disrupted, and reborn inside a single decade. And yet, when fear rises, when inflation accelerates, when confidence in institutions erodes, many still instinctively reach for a metal whose settlement layer was designed for a pre-industrial world. That instinct is understandable. It is also increasingly mismatched to reality. Gold's role has always been to protect against the abuse of money. It was a hedge against human discretion. But gold itself is embedded in a system that now depends entirely on trust in intermediaries. Most gold today does not move. It sits in vaults. It is represented by paper claims, ETFs, custodial receipts. You are not holding gold. You are holding a promise about gold. And that distinction matters far more than most people want to admit. Because every promise introduces a point of control. Every point of control introduces fragility. And fragility is the enemy of freedom. Now, contrast that with a network that does not ask for permission, a system that does not care who you are, where you live, or what you believe. A protocol that enforces its own rules, not through authority, but through mathematics and distributed consensus. Bitcoin did not emerge because someone wanted to create a better investment. It emerged because a generation that lived through repeated monetary crises understood something profound. Trust had become too centralized, and the cost of that centralization was being externalized onto everyone else. I want to pause on that word, externalized. When governments debase currency, they call it stimulus. When central banks suppress interest rates, they call it support. When debt expands beyond any plausible path of repayment, they call it management. But the real effect is simple. The consequences are pushed outward. They are absorbed by savers, by wage earners, by anyone who holds cash or fixed income instruments. Inflation is not a mystery. It is a policy outcome, and it is a tax that does not require a vote. Gold historically offered an escape hatch from that tax. Bitcoin offers something fundamentally different, an opt-out from the entire mechanism. This is where many critics stop listening. They hear ideology where there is actually architecture. Bitcoin is not a political statement. It is a technological one. It says that rules can be enforced without rulers, that scarcity can be guaranteed without violence, that ownership can exist without a registry controlled by the state or a corporation. These are not abstract ideals. They are concrete properties that can be tested, verified, and audited by anyone with an internet connection. Scarcity is the core of this discussion. Gold is scarce in a geological sense, but not in a technological one. We do not know how much gold exists in the Earth's crust. We do not know what future extraction technologies might unlock. We do not know what happens when space mining becomes economically viable. Gold supply growth has been relatively stable historically, but it is not immutable. It is responsive to price, to innovation, to incentives. Bitcoin scarcity, by contrast, is absolute. 21 million units. No more, no less. That limit is not enforced by trust in an institution, but by a global network of participants who have aligned incentives to preserve it. Changing that limit would require convincing the majority of the network to devalue their own holdings. That is not governance by decree. It is governance by economic self-interest, and that is precisely why it works. Think about how radically different that is from the monetary systems we have accepted as normal. In our current framework, a small group of policymakers can alter the monetary base with a meeting and a press conference. They are not malicious. I want to be clear about that. Most of them are sincere. They believe they are doing good. But good intentions do not negate unintended consequences. And history is unambiguous on this point. Concentrated control over money eventually leads to its abuse. Bitcoin removes that temptation entirely. There is no lever to pull, no emergency meeting that can dilute supply, no moral hazard created by the promise of rescue. That is not rigidity for rigidity's sake. It is discipline embedded in code. Gold advocates often argue that Bitcoin lacks intrinsic value. I find that argument fascinating because it reveals how deeply we misunderstand value itself. Gold's value is not intrinsic in the sense of utility. We do not eat it. We do not build houses with it. Its value emerges from collective belief in its monetary role. Bitcoin is no different in that regard. The difference is that Bitcoin's monetary properties are superior for a digital, global, permissionless economy. Portability matters, divisibility matters, verifiability matters, settlement speed matters. Try moving $1 billion worth of gold across borders without relying on a web of intermediaries, approvals, and delays. Then try doing the same with Bitcoin. One requires trust in institutions, the other requires trust in math. And here is where the conversation becomes less about assets and more about agency, because what we are really debating is not Bitcoin versus gold. We are debating centralized trust versus distributed trust. We are debating a world where access to financial sovereignty is reserved for those with privilege, versus a world where it is available to anyone willing to learn and participate. I have spent my career investing in disruptive innovation, not because disruption is fashionable, but because it is how progress actually happens. The printing press disrupted religious authority. The internet disrupted information monopolies. Open source software disrupted proprietary control. Each time, the same arguments appeared. It's too volatile. It's too risky. It's not real. And each time, those arguments missed the deeper pattern. When technology lowers the cost of trust and coordination, power shifts. Bitcoin lowers the cost of trust in money itself. Volatility is often cited as Bitcoin's fatal flaw. I see it as evidence of price discovery in real time. Gold had centuries to establish its role. Bitcoin has had just over a decade, during which it has faced constant skepticism, regulatory hostility, and misunderstanding. And yet, through multiple cycles, through bans, through crashes, it has continued to function exactly as designed. Blocks are produced. Transactions are settled. Supply issuance follows its schedule with mechanical precision. That resilience is not accidental. It is the result of incentives aligned at a global scale. Miners, developers, node operators, holders, and users all play distinct roles. Yet none of them individually control the system. That is anti-fragility in action. I want you to notice something important. Every criticism of Bitcoin that focuses on energy use, volatility, or lack of central oversight implicitly assumes that the existing system is the neutral baseline. It is not. The current system consumes enormous energy, both literal and human. It creates volatility in purchasing power that is simply normalized. It relies on layers of bureaucracy and enforcement that we no longer even see because we have grown accustomed to them. Bitcoin makes costs visible, and people often resent that visibility. Gold feels safe because it is familiar. Bitcoin feels unsettling because it exposes how much of our confidence has been borrowed rather than earned. But safety that depends on ignorance is not safety at all. At ARC, we do not invest based on comfort. We invest based on trajectory. We ask where technology is taking us, not where nostalgia wants us to stay. When I look at Bitcoin, I do not see a replacement for gold in a narrow portfolio construction sense. I see a new monetary asset native to the internet competing with gold, bonds, and even certain forms of real estate as a store of value. And this is where the decision becomes unavoidable. You can dismiss Bitcoin as speculative. You can tolerate it as a curiosity. You can even profit from trading around it. But you cannot ignore the question it forces on us. Do we want money that can be altered by policy, or money that is governed by rules no one can bend? Because once you understand that question, once you really internalize it, you realize that holding gold inside a financial system built on discretionary money is only a partial hedge. It protects you from some risks, but not from the structural ones. Bitcoin, by contrast, exists outside that discretion. It does not eliminate risk, nothing does. But it changes the nature of risk from political to mathematical. That shift is profound. And it is why I believe we are still at the beginning, not the end of this transition. Institutions move slowly. Narratives lag reality, and most people only change when the cost of not changing becomes too high. I said at the beginning that I would reveal a fundamental truth about freedom that few are willing to accept. We are almost there. But before I say it plainly, I want you to consider one more thing. Every generation inherits a set of assumptions about what is normal, what is possible, and what is immutable. The greatest breakthroughs happen when someone questions the assumption that seemed most obvious. In finance, one of those assumptions is that money must be issued, managed, and ultimately controlled by centralized authority. Bitcoin challenges that assumption at its root, and that is why the debate around it is so emotional. It is not just about returns. It is about legitimacy. It is about who gets to decide the rules of the game. Gold once played that role of external discipline. In a world of nation-states and physical settlement, it was the best tool available. But we no longer live in that world. We live in a world where software eats everything, including money. And when software eats something, it does not politely coexist. It redefines it. The decision I have made is not based on ideology. It is based on observing how systems evolve. When a new system is more transparent, more resilient, more inclusive, and more aligned with individual sovereignty, it eventually outcompetes the old one. Not overnight, not without resistance, but inexorably. And this brings us right to the edge of the truth I promised, because the real divide here is not between Bitcoin and gold, but between those who are willing to take responsibility for their own financial autonomy and those who prefer to delegate it, even if that delegation slowly erodes their freedom, because delegation feels safer than self-sovereignty when you have been trained to fear it. And that is exactly where many people pause, hesitate, and look back toward the familiar, even as the ground beneath the familiar begins to shift in ways that cannot be reversed by policy announcements or comforting narratives, because the underlying incentives of the system are no longer aligned with long-term value preservation, but with short-term stabilization that compounds fragility over time and quietly conditions us to accept less control over our own economic lives as the price of order. Here is the truth that makes many people uncomfortable. Freedom is not something granted by stable institutions. It is something preserved by systems that limit the concentration of power. And money sits at the center of that reality. If you control the money, you eventually control the choices. If you can dilute purchasing power, you can redirect behavior without ever issuing a command. That is why the architecture of money matters more than almost any other social technology we have ever built. For decades, we have lived under the assumption that stability requires centralized discretion, that without a guiding hand, markets will spiral into chaos, that individuals cannot be trusted with sovereignty, so it must be managed on their behalf. And every crisis has been used to reinforce that belief. Each emergency justifies a little more control, a little more opacity, a little more distance between cause and consequence. Bitcoin represents a rejection of that assumption, not through protest, not through politics, but through design. It assumes that individuals can coordinate peacefully without a central planner. It assumes that transparency beats authority. It assumes that predictable rules create more trust than discretionary power. Those are radical assumptions only because we have forgotten that they once underpinned the most prosperous periods in human history. When people ask me why I prefer Bitcoin to gold, they often expect a technical answer. Hash rates, adoption curves, network effects. Those matter, but they are secondary. The primary reason is philosophical, grounded in observed reality. Gold constrains governments imperfectly. Bitcoin constrains everyone equally. There are no exemptions, no special access, no backdoors for the powerful. That equality before the protocol is not a slogan. It is enforced every 10 minutes, block after block, regardless of who is transacting. In a world increasingly defined by unequal access and asymmetric influence, that property alone should command attention. Let's talk about adoption, because this is where theory meets reality. Bitcoin adoption is not being driven by ideology alone. It is being driven by necessity. In countries with unstable currencies, people do not debate whether Bitcoin is elegant or crude. They ask whether it works. Can it preserve value across time? Can it move without confiscation? Can it function when trust in institutions collapses? And again, the answer has been yes. Gold in those same environments often fails the practical test. It is heavy. It is difficult to divide. It is easy to confiscate at borders. It requires physical security that many people cannot afford. Bitcoin requires only memory and connectivity. That difference is not academic. It is existential. Now consider the institutional perspective. We are witnessing the early stages of Bitcoin's integration into the global financial system. Custodians are emerging, regulated products are launching, corporations are adding it to their balance sheets. This is not because Bitcoin has become less disruptive. It is because institutions are slowly realizing that ignoring a superior monetary technology is more dangerous than adapting to it. Some worry that institutional adoption undermines Bitcoin's original purpose. I see it differently. Institutions do not change Bitcoin. Bitcoin changes institutions. They are forced to operate within its constraints. They cannot print more of it. They cannot rewrite its rules. They can only choose how much exposure they are willing to have to an asset they do not control. That inversion of power is unprecedented in modern finance. Gold never achieved that. It always required vaults, guards, treaties, and enforcement. Bitcoin requires consensus and code. And because that code is open, anyone can verify it. Transparency is not a feature layered on top. It is the foundation. Let me address another common objection: regulation. Many assume that governments will simply regulate Bitcoin out of existence. That assumption misunderstands both regulation and Bitcoin. Governments can regulate on-ramps and off-ramps. They can regulate companies. They can regulate behavior within their jurisdiction. But they cannot regulate a decentralized protocol into not existing any more than they can regulate mathematics. More importantly, governments themselves are constrained by incentives. As Bitcoin adoption grows globally, unilateral hostility becomes costly. Capital is mobile. Talent is mobile. Innovation flows toward jurisdictions that respect it. Over time, regulatory frameworks evolve not out of ideological alignment, but out of competitive necessity. We have seen this pattern before. The internet was once viewed primarily as a threat, then as a tool, then as critical infrastructure. Bitcoin is moving along the same trajectory, but with far higher stakes because it touches money itself. Gold does not provoke this kind of response because it does not threaten the architecture of power. It is already absorbed. It already fits. Bitcoin does not fit, and that is precisely why it matters. I want to be very clear about something else. Choosing Bitcoin over gold does not mean rejecting prudence. It means redefining it. Prudence is not clinging to what worked in the past when the underlying conditions have changed. Prudence is understanding the direction of technological and social evolution and positioning accordingly. At ARC, we talk often about convergence. Technologies do not evolve in isolation. Artificial intelligence, robotics, energy storage, blockchain networks, these systems reinforce one another. Bitcoin sits at the intersection of several of these trends. It is software. It is a network. It is energy intensive in a way that incentivizes innovation in power generation. It is financial infrastructure that operates independently of legacy rails. Gold sits outside that convergence. Its value proposition is static. Bitcoin's is dynamic. And here is where the long-term perspective becomes essential. Short-term price movements distract from long-term adoption curves. If you focus only on volatility, you miss compounding. If you focus only on headlines, you miss incentives. The most transformative technologies look chaotic before they look obvious. I am often asked whether Bitcoin is too risky. My answer is that not understanding Bitcoin is increasingly risky. Risk is not just price fluctuation. Risk is holding assets whose value depends on policy decisions you do not control, in systems whose debt dynamics are mathematically unsustainable. When you step back and look at global balance sheets, the picture is sobering. Debt has grown faster than productivity for decades. Interest rates have been suppressed to service that debt. Suppression distorts capital allocation, distortion breeds fragility, fragility invites intervention, and intervention accelerates the cycle. Bitcoin is not a cure-all. It will not fix bad policy. It will not eliminate cycles. But it offers an exit from a system where the rules change reactively and asymmetrically. It offers a baseline of certainty in a world of managed uncertainty. That baseline is what gold once provided. But gold's enforcement mechanism was physical scarcity. Bitcoin's enforcement mechanism is collective verification. In a global digital economy, the latter scales more effectively. Let's talk about the future for a moment. Imagine a world where billions of people have access to a neutral, global monetary network, where savings cannot be arbitrarily diluted, where cross-border payments settle in minutes, not days, where financial inclusion does not depend on proximity to a bank branch or approval from a centralized authority. That world does not eliminate inequality. Nothing does. But it changes the starting conditions. It gives individuals tools rather than promises. And tools empower behavior change in ways that policies rarely do. This is why the Bitcoin versus gold discussion matters so deeply. It is not about which line goes up more on a chart. It is about which system aligns better with a future defined by decentralization, transparency, and individual agency. Gold belongs to a world where trust traveled slowly and power was localized. Bitcoin belongs to a world where information is instant and power is increasingly contested. One is not evil, the other is not perfect, but only one is natively compatible with where we are going. Now, I want to fulfill the promise I made at the beginning. The fundamental truth about freedom that few are willing to accept is this: freedom requires constraints, but the right kind of constraints. Constraints on power, not on choice. Constraints embedded in systems, not imposed by authorities. When constraints are placed on individuals, freedom shrinks. When constraints are placed on institutions, freedom expands. Bitcoin places constraints where they belong. That is why I have made my decision. Not because Bitcoin is trendy, not because it is easy, but because it represents a monetary system where the rules are known in advance, applied equally, and resistant to capture. Gold served that role once. Bitcoin serves it better now. The call to action I leave you with is not to buy anything. It is to think deeply, to read original sources, to question inherited assumptions about money, value, and authority, to ask yourself whether the systems you rely on are designed to preserve your autonomy or merely manage your dependence. History does not reward complacency. It rewards those who understand structural change early and act thoughtfully, not emotionally. Bitcoin versus gold is not a debate about the past. It is a decision about the future. And that future will be shaped, quietly but decisively, by whether we choose systems that trust individuals by design or systems that ask individuals to trust power and hope it behaves itself. I know which side of that decision I am on. And this brings us right to the edge of the truth I promised, because the real divide here is not between Bitcoin and gold, but between those who are willing to take responsibility for their own financial autonomy and those who prefer to delegate it, even if that delegation slowly erodes their freedom, because delegation feels safer than self-sovereignty when you have been trained to fear it. And that is exactly where many people pause, hesitate, and look back toward the familiar, even as the ground beneath the familiar begins to shift in ways that cannot be reversed by policy announcements or comforting narratives, because the underlying incentives of the system are no longer aligned with long-term value preservation, but with short-term stabilization that compounds fragility over time and quietly conditions us to accept less control over our own economic lives as the price of order.